no, what's he doing? Oh, don't go there. Oh, this gonna hurt. Oh, he's going to the hospital. Yeah, I'd say at least 2 weeks. I hate hospital food. You know, there's just no saving some of these kooks. Never ever turn your back on the ocean. Which reminds me, never ever ever turn your back on the mortgage business. And these high rates are making tough swells for some looking for home financing these days. And I've seen way too many mortgage wipeouts recently. So let's visit the likely reasons for decline so you can hang 10 on your next loan request. What makes sense about the housing market in 2024? Mortgage rates are up 250% from just a few years ago, while home prices are at all-time highs. So who dare buy in this market, yet every day your Redfin notifications show your favorites are swept off the market. Contracts are what dreams are made of. That is until the nightmare of loan underwriting unfolds. It's Matty Loans, the mortgage Laird Hamilton, back with another episode of Mortgage A to Z. And this week we discuss M, as in mortgage wipeout. Ask any lender with a pipeline that loan approvals are rough seas. It seems as if the system is set up for another massive bomb. Have money and don't need it? You're approved. Need it because your life depends on it? Don't hold your breath. To better prep you for the undertow, aka underwriting, we're going to drill down on the system, the people in the process or lack thereof, and uncover my top reasons why your loan's getting denied right now. Some of these issues you can avoid, some you can't, but I'll give you tips either way to ride this one out. On the surface, the mortgage process appears simple. Act 1, complete a loan application and credit check, and in return receive an approval letter. Act 2, find home, make offer, receive contract, followed by the final Act 3, trade all your data for the largest commitment of your life. The idea of push button get mortgage has ruined the experience for those actually enjoy working with a real human, as the system today involves less people and more technology. If you don't feel good about self-driving cars, how do you feel about automated underwriting? Now that gives me the creeps. Therefore, a key reason why people are getting declined today isn't human error, but lack of human participation. It may seem counterproductive to work with a real-life person when you can just email it in. But working with a professional that understands your situation and the circumstances can be the difference between a loan approval and denial. I recommend that you work with a real-life loan officer always, hopefully one that can write in cursive and still drive a stick shift. Most loan applications today bypass the telephone altogether because the process today is software-based. There's software that collects your data from the loan application, followed by more software to underwrite the file. Note, most of the loans produced today are not underwritten by a real person. They're actually approved by a decision engine, a bot. If you've ever heard of DUNLP, that stands for Desktop Underwriter in Loan Prospecting, essentially the ghostwriting of underwriting. So the bots determine if you're approved, denied, or suspect. And this makes your data entry key, and if you did it all by yourself online, that could be a potential pitfall. Another could be the paperwork supplied that doesn't exactly match up with your application. It could also be a simple verification of employment that doesn't match your current salary. Now, it's understandable in this day and age that less personal interaction is more. That is until something goes wrong. Too much of the process involves O's and 1's where underwriter discretion is absolved. The system can work great if you're buying a single-family detached property, you're W-2 privileged, and you've saved all of your allowance money since the 8th grade. Like most of the software out there, it was written by engineers, not people in the business. So if the shoe fits, great. But here are my top reasons why your loan may need CPR. This first example may be the toughest of them all because there's nothing that you can do about it. Many buyers start the loan process from a what can I afford perspective based on monthly payment and down payment. If there's no specific property in mind, the default option may include a single-family detached property. However, with the entry to homeownership being so high today, sometimes a single-family detached residence isn't an option, and therefore alternative properties may be considered. A great example of this may be a manufactured home type. Many of these homes look just as good as stick-built, and on the outside, no one can tell the difference. But just because you can't doesn't mean the lender won't. In most cases, due to the setup of the utilities and infrastructure, these types of properties are higher risk, and as a result, still can be financed just at a premium rate. So imagine you applied for a loan based on the lowest rate possible and highest purchase price and payments supported by your qualifications, only to select a double-wide manufactured home where your rate goes from 7% to 8.5%. Seems harmless enough, but in this market, every dollar counts. It could be just enough to keep your loan from getting approved and you getting caught inside. Another example, condominiums. Most people don't understand that when they qualify for a condo property, not only must they qualify for the loan, but also the HOA must qualify as well. Not always, but often, condos need to be approved based on the master insurance, the percentage of owners in the HOA that occupies their primary residence, and also the budget reserves. Even if your qualifications are sterling, your income's great, your down payment's ample, and your credit is perfect, a condo property with a project HOA where there is a majority of investors may be reason enough for a decline because the projects require a certain percentage of owner-occupied properties. Regardless if you are buying for primary use or investment, the fact that the project already has a majority of investor units may make this setup hard for traditional financing. You might have to find a hard money loan, pay cash, or move on to another condominium neighborhood altogether. While the lender is evaluating your qualification, they'll also be reviewing the HOA's CC&Rs, the insurance docs, and the condo questionnaire, all of which takes time and may slow the process or complicate the approval. Another example of denial that you can't manage involves unique properties, and these are more popular out west, involving homes with no public water that may require hauled water. Not all homes are located on the grid or have access to water, so what they do is set up a contract with water companies to deliver water. Sound like a solution for your Amazon cart, right? Well, not exactly, because it presents another high risk, and what happens if that water company goes out of business or they decide to no longer service your location? See, it may not be a city requirement to supply water, so you might be on your own, and then make it a hard time to finance because of the risk involved. Unless there's an investor appetite for your property characteristics, that may make it hard. And stop and think about the long-term impact. If there's limited investment for your loan, it could be an issue when you go to sell the home. Details matter, and though out of your control, the property type could be a barrier for your approval. Then there's credit. It makes up 1/3 of your loan application, so it's very important, and a major factor in mortgage denial. Loans can be rejected outright if you don't have the minimum credit score, or have recent lates, which makes your profile high risk. Most lenders will adjust their rates accordingly to credit scores, so do your very best to keep it optimal. Say over 700 to say the least. You'll get better rates with higher credit scores, so maintaining excellent credit can serve you well, not only for rates, but also program availability. In addition of low down payment programs like Home Ready and Home Possible, these create choices for new buyers that may have only considered FHA type finance. However, there are minimum credit scores to qualify for these programs, and if you don't meet the credit characteristics based on score, you may be relegated to FHA finance. And one of the benefits of an FHA loan is that it allows for lower scores like 580, but it does have the potential offset of higher mortgage insurance costs monthly, but also the closing costs associated funding. So understand that if Plan A doesn't work out for your credit, there may be some alternative programs to consider. It's important to remember that it takes a lot of patience in this housing market where there's limited inventory, and as a result, it may take months to find a home, let alone dream home, and then get your offer accepted. Generally speaking, your credit approval usually expires with the credit report, and thus a new credit check updated every 4 months. If you started your mortgage around the first of the year, it may have expired by now, and therefore time to get a new credit check to extend your approval for another couple months. If you have great credit when you begin and for some particular reason your scores drop because of usage or a recent slow pay, maybe even a medical bill, it may change your rate but also change your loan approval. It's important to review your credit scores before you begin the house hunt, and while doing your home shopping, refrain from opening any new trade lines that may have an impact on your qualifying ratios. A little fun fact about qualifying is that the lender will always budget a payment for your revolving credit trades. In plain English, your approval will consider all your debt reported on your credit report, even for the credit cards you don't carry a monthly balance. So even if you're doing the responsible thing and paying off your credit card bills monthly, the lender will still budget a minimum monthly payment, say 25 or 50, maybe at least 5% of the respective balance. So for example, if you have a $5,000 credit card bill, the bank will still hit you with a budget of $250 for this account monthly. The bank needs to earmark some of your income to service this debt, and the system doesn't know that you pay it off monthly. Some cards like American Express require to be paid in full and may require you to have sufficient assets to cover that balance or may require a manual calculation for that expense. Just consider every account that you use, especially the accounts you're co-signed to. If you recently applied for a mortgage and a couple months ago co-signed for your brother's auto loan, there may not be enough history of payments to unassociate you with this debt and not take this liability on. I've witnessed deals being declined because of the revolving balances have increased over time and the inability to approve responsibility for co-signed debt. So it could change the approval. Last pitfall with credit is student loan debt, and it's a complicated topic because the calls for cancellation, but also verifying the terms of repayment once out of deferral. The credit report doesn't provide any details on the terms or conditions of repayment of any student loan debt, so the onus is on you to supply the terms and conditions to allow the lender to make for a de facto payment expense. Like credit cards, they may hit you with a monthly minimum, say 1 or 2% of the balance to qualify. The type of loan you are looking to qualify for may have more to do than the actual lender. And now the big kahuna and the most notorious reason why you're going over the falls is that your debt-to-income ratios exceed the thresholds of loan approval. Lenders like to see a max percentage, say 43% of your total gross monthly income as a commitment to your debt. Say you make $10,000 per month gross, the lender will want to see all of your existing debt and new debt, meaning your new mortgage payment, the taxes, the insurance, dues, whatever, not exceed $4,300 per month. If you're above this ratio, then the lender may limit the amount of additional debt, provided you have the flexibility for more down payment. If not, your loan may be denied outright. Now, there are certain exceptions that are applicable, just not always. Say also you're a two-vehicle household and you have 2 auto loan payments. Your debt to income is 50%, for example, with a new mortgage and both of your existing car loans. You may get denied or suspended due to excessive ratios. A counteroffer may suspend your loan and give you the grace to sell one of the 2 cars so you can disposition this expense from your DTI ratios. In this market, we often see excessive DTI ratios when clients want to buy the new home before selling the old, even if you don't need the sale of the old home to commit to the down payment for the new home. The lender may still say you can't qualify covering 2 homes simultaneously with 2 mortgages, despite the fact that you plan to sell the old home soon after or right after the closing on the new home. This is an example of the human factor because you planned all along not to committing to 2 homes and 2 payments, but the system still holds you accountable in the long and the short term. Sometimes your DTI is black and white, but often for the self-employed, there's a lot of gray area. DTI does not always tell the story because self-employeds may commingle business and personal expenses, and sometimes they're able to separate these, and when not possible, can lead to denial. Most self-employeds have irregular income. Regardless of the high earning potential, there are often business cycles or variations that the automated system can't help with. If self-employed, prepare to send in a minimum of 2 years tax returns. Odds are your earnings may not be consistent enough to have the system automatically approve them, and it may require a manual underwrite in the evaluation of more data like income statements. If the system prefers automated underwriting and you require a manual underwrite, now it may increase the odds you may not receive a fluid approval process. The system's so conditioned for the automated results, no one wants to put their name on the line for something outside of standard operating procedures. When it comes to the self-employed, any bot can provide you with an approval or denial, but it takes a true professional with a knack for understanding all the facets of your income. Many business owners max potential write-offs to reduce their tax liabilities. And sometimes business expenses show up on personal credit report and need to be excluded from the ratios to qualify. Self-employed people know what their cash flow is, but can't predict what an automated system is going to produce as far as their qualifications. Some lenders in this market will provide a pre-approval letter for anyone self-employed until they verify their taxes and determine their qualifying income. Self-employed may put $25,000 a month for their income on the online application, only to receive half of that post-auto underwriting. It's hard to anticipate the reason behind the reduction in income, maybe something as significant as the most recent tax return or the Schedule L. Remember, most self-employed people don't prepare their tax returns. So when there are explanations requested, the denial may be only overturned with a comfort letter from the CPA or more recent financial statements. Those are my reasons for going ragdoll, but there's always more. Moreover, there's always a few ways to cut back that are practical and pragmatic. Start by being an active participant in your process. If your loan's first denied, don't go away. Search out alternative programs with the same lender. If your initial lender doesn't have alternatives, move on to another lender that has programs to help you overcome whatever issue you're dealing with. A lot of this business is communication, and the earlier the problems are identified, the better. No loan officer or client appreciates a denial at the very end, but it makes it impossible to switch lenders and keep the same closing date. I'm all for the use of technology, but the downside is that it can make people sleepy and can make it too easy to get off track for closing. Best practice is to work with an active loan officer. It makes sense if you're self-employed to bypass the automated system and work directly with a loan officer one-on-one. A great LO will ask questions, assess the pros and cons of your circumstances, and provide contingency plans when things go off course. It's the people business, and it's important to stress the time needed for a self-employed business owner and all the help they require, from bookkeeping of financial statements to tax prep from accountants and financial plans from their advisors. More documentation will require more time to gather and review, so having a loan officer organize your file will go a long way. Oftentimes, a lending approval or loan commitment can seem ambiguous regarding the needs to close the file. An example of this may be proof of liquidation of assets when the source of down payment may come from an open credit line or an outstanding bonus or distribution. What happens when the sale of the departure residence falls through? This could have a domino effect, and will you be able to continue with closing? What happens if you change jobs? These are questions the best loan officers can handle and should have the experience to guide you through the closing. Understand that there are always alternative sources of financing, like non-QM loans. These type of loans have expanded parameters that provide higher loan amounts, higher LTVs, and higher debt-to-income ratios than the plain vanilla lender. They may also accept alternative income documentation, qualifying via income statements. Finally, sometimes you have to fight the power. We all know that the system loves autopilot, but nobody likes the liability. If you're declined, ask for a manual underwrite of the file. On some of the larger loans, what they refer to as jumbo loans are exclusively manually underwritten. Prepare to send in additional loan documentation, maybe an extra year or two, maybe audited financial statements, or maybe letters from CPAs stating the use of the business funds are permissible and will not have an impact on the feasibility of the business. These things help, and they will matter in the end. Long gone are the days of deal by handshake. The tide has turned, and I'd expect more automation as the years pass by. The benefit of technology is that it does improve closing times, but it is yet to eliminate inefficiencies, especially with complex clients that need jumbo finance or a self-employed business owner. Today's underwriting system can feel like there's no lifeguard on duty, so a great loan officer can be a lifesaver. Understanding lending is not always black and white, and if your profile's got a lot of gray, use some of these tips to duck dive. Remember to request a manual underwrite if possible, seek alternative programs, and stay engaged in your process. Until then, stay stoked.